We're now going to look at section 8, capital C, section 8C, the taxation of directors and employees on the vesting of equity instruments. Now this section talks about the situation where the employer company gives some of its shares to its directors and or its employees. Not to all of them. It's not a broad-based employee share scheme. That is not in your syllabus. But this is, for example, you give to the board of directors or to the upper management, those type of share schemes. Now, the person who is receiving it, the employee who is receiving the shares, that person is getting a benefit. Now, guys, this section is very simple, but it is a section which, when they ask it, people do very poorly in it. And the reason for that is purely, in my opinion, because they don't pay attention to the order in which things flow. If you know exactly which year you're looking at and what part of the process you are in, this is very, very simple. Alright, so understand now. The idea here is that if I draw it up like this, an employer, which is a company, gives shares to its employees or directors. We are looking at it from the employees' directors' side. They are getting a benefit that must be taxed. Now, let's quickly just, before I continue with anything there, let me quickly just talk to you about what the benefits are. The benefits are, let's say the share has a market value of 100 rands. You get one share. If you get it for free, so less consideration, if you get it for free, there's a value of 100 rands. If you pay 30 rands for it, you get a value of 70 rands for it. I want you to just quickly for now also see it is possible that you could pay 120 rands for it and have a loss of 20 rands as well. Now you might say that this seems strange. Why would you ever buy something for 120 rands versus worth 100 rands? And that's not what we're looking at here. Okay, I'm just pointing out to you, please understand that this situation can exist, and I'll explain to you in a second how. Now, that is the benefit you calculate. Now, the issue here is with section 8C, is that you should only be taxed, this employee should only be taxed when the share vests in them. Now, what that means is, and practically what happens is, there are sometimes when they give these shares, there are vesting conditions attached. So let me just use this as an example. Your employer goes to the directors and says, listen, I'm going to give you a share. You can pay, well, let's actually do it for free. You can pay 0 rands for a share, okay, for the market value of the share, today. But one of the conditions, there's a condition attached to this. And that condition is you cannot sell it until 5 years have passed. Now, for the purpose of section 8C, that means that this share has not yet vested in the person. It will only vest in 5 years' time when the conditions have all the vesting conditions have been met. So you'll see there will be vesting conditions given to you sometimes where they'll say you can't sell it until you retire, you can't sell it until you leave. It doesn't become your property until you've worked 2 years. It doesn't become your property until you've reached R1 million in sales. Whatever the condition might be, they can give it. You just need to see if it's been met or not. Now, until that condition has been met, right, that is the day that vests, you do not tax the person. So, let me explain. If I say today, you cannot sell the shares until 5 years have passed. After 5 years, right, so let me show you. So, what will happen today is you will say, what is the market value of the shares today? Less the consideration. That value, I'm jumping a little bit ahead here, but I'm going to just quickly show you what will happen. This is today's tax. That value of the share will be included, but there will then be, I'm just going to quickly show you, an exemption section, section 10.1 ND, which is a little bit further in the notes. Section 10.1 ND will apply. Okay, so let me explain to you up to there. So I've said to you now, you get the share today, but it doesn't vest until 5 years have passed. Now what I've explained to you so far is they want to tax you when it vests. So today you do receive something. Section 10(1)(nd) is there to stop this from being taxed because they say, has it vested today when you received it? The answer is no. So the net effect is null. Okay? After 5 years, you'll do the same calculation. The difference is that market value is going to change. So let's say after 5 years the market value is 150 rands. Then you'll say the share vests, section 8C, 150 rands. That's basically what this whole section is. Okay, so this is going to see it in the Act. So here's section 8C 1A. So what this section tells us is this part over here, that you need to include it. Okay, when it vests. So see what it says. It says, notwithstanding sections 9C and section 23M. So they say section 9C still applies, which is the section that says if 3 years, if you've held a share for 3 years and you sell it, it's capital if you are a share dealer. Section 23M tells you that an amount tells you what you can claim as a deduction. So they say we're not ignoring that section. It says, but the taxpayer must include in or deduct, see, include or deduct from his or her income for a year of assessment any gain or loss determined in terms of subsection 2 in respect of the vesting during that year of any equity instrument. Equity instrument is a share. If that equity instrument is acquired by the taxpayer by virtue of his employment, by virtue of any restricted equity held by the taxpayer, in respect of which this section will apply upon vesting thereof, as a restricted equity instrument during the period of his employment, right, from that company. So that's actually up to date, that's enough. I just want you to see, you basically get it when it vests. That's what they point out. Section 10(1)(nd) then says, remember, so this doesn't show, this is the exemption section. It says, any amount which is received by accrued to that payer, which constitutes an equity instrument in terms of section 8C, acquired by that person and in respect of which the section applies, or consideration for the disposal of an equity instrument, which had not yet vested. So they say, you apply section 10(1)(nd) when it has not yet vested. That is the reason why, in my example, and I'm going to quickly explain to you again. I say, today you get shares, right? 100 rands, the shares are worth 100 rands today. You don't have to pay anything for it. You get it today, but they tell you you can only sell it, so it only vests in after 5 years. So today you get 100 rands worth of share, whatever the market value is today, and section 10(1)(nd) applies because it has not yet vested. So the net effect is null. After 5 years it vests, you perform the same calculation, which is shares less consideration, but you use whatever the market value is on the date it vests, which is 150 rands, and you still haven't paid anything. Now, this example here, or the Act tells you you can include or deduct an amount. What do they mean by that, guys? Means the following. Let's say those shares today are worth 100 rands. Your employer tells you, listen, you can buy these shares for 80 rands. All right, so you get a discount. Right, so there's a 20 rands that you make. Now what I want you to see is that 20 rands today, it's still the same example, you get it today but it vests in 5 years. So today you put in the 20 rands and it is fully exempt. Right, so it's always the net effect. After 5 years when it vests, okay, so I'm going to show you two examples. First one is after 5 years when it vests, let's say the market value is now 150 rands. Right, so you've paid 80 rands, so 70 rands is the amount. So 70 rands will go into your taxable income. That's the one scenario. But now, let's say after 5 years the market value has decreased. It's now 50 rands. You've paid 80 rands. Now there's a 30 rands deduction for you. Right. So that's how it will happen, because you don't know what's going to happen in the future. So it can have a loss. Okay, so here are the steps Shajes Baker spoke of. When you acquire it, include the difference in your gross income, but it is then exempt if it has not yet vested. When they vest, include the difference. And then when you sell it, right, if you're a share dealer, it's gross income. And there's a deduction for it when you get it. If you are holding it as capital investment, it's capital in nature. The base cost of the share, if it's capital in nature, they say in paragraph 21HI, in the case of a marketable security or equity instrument, the acquisition or vesting, as the case may be, which resulted in the determination of a gain or a loss in terms of section 8C, right? The market value of that marketable security will be the base cost. So they say the market value on the vesting date will be the base cost. So if I take you to my example we just used now, where it tells you after 5 years, you do this calculation, market value less consideration, whatever the market value is when it vests, that is the base cost. So if you sell this share now, a year later, for 80 Rands or for 100 Rands, now let's make it 120 Rands, you'll say proceeds 120, base cost the 50, whatever the market value was on the date it vested. Alright, that's it.